Good morning, everyone. And today, in this session, we are going to talk about things we generally don't talk about or don't like to talk about, risks to our life, and how insurance can help us overcome these risks or mitigate their financial consequences on your life. Before we start, this is what we will be covering. This is the sequence of events on this broadcast. This is types of, first of all, let's have a look at the types of risk we face and what are the consequences of these risks. And then, if insurance can do something about it, and types of insurance you can have to cover against these risks, and anything else that is there that you should take care of. Before we move on, a small disclaimer: anything that we discuss on this or you hear on this uh, webinar is it should not be taken as a financial advice. If you need financial advice, you can connect with your financial advisors or you can connect with me. Contact information will be given at the end of the webinar to all of you. So uh, these are a few principles we abide by in, and they have been drawn from uh, ancient knowledge, ancient wisdom about war and leadership. We should know about ourselves, our weaknesses, strengths, and financial situations before we go on purchasing or investing in financial products. So that's why knowing your goal and objective and knowing yourself both are important if you want to make a positive financial decision. And as always, anything that you do today should ensure your safety, your financial safety, and your family's safety in the future. And every action should strengthen it, not weaken your safety. So, with this, let's have a look at what kind of risks we have. So, there are a lot of them, but for simplification, to understand better and to address them, we can classify them in several different types. So, one of the most common risks is the illness, and illnesses can be of many types. There can be chronic minor illnesses like cold and cough and viral fevers, but there can be also serious illnesses which require hospitalization or rehabilitation after recovery. Then there are disabilities. Some people can face disability in uh, in eyes, one of the five organs, or motor functions. So these disabilities can also be of multiple different types. Then there can be accidents, there can be injuries, and we all know death is a kind of permanent and everybody gets it one uh, sometime in their life. So death is kind of separate, is a very different kind of risk. So we'll have a look at it at a different point of time uh, in this discussion separately. So for insurance purpose, insurers will define your these kind of risks under all these heads, or they can classify the risk uh, in a different category based on the consequences or based on the effect it has on your life. So, for example, disability can be total. Total disability insurance in insurance lingo, you may hear total permanent disability or total partial disability. Total disability means you are unable to move and you are bedridden for a while. That means you do not have any motor functions uh, for that period of time. Partial disability again is a type. It's not total, but maybe one hand is not you're fractured. You're not able to use that hand or a leg, or you have a hearing impairment in one of the ears, or you can't see through one of your eyes. So one organ failure is partial disability. Then there is disability which can last for a few months, but there can be also disability which lasts for more than 2 3 years. If it lasts for more than 2 3 years or more than 6 months, it is called permanent disability. And definitions can range. The time period can change based on the disability and based on the insurance provider. So you may want to look at the fine print of the policy document to understand what kind of disability they are covering and what kind of benefits are available for those disabilities. Permanent disability is considered that you have permanently lost the function of that organ. Let's say you lose a hand. Uh, so when amputation occurs, that is a permanent loss. That kind of loss can be permanent. But if you lose only one hand, it's a partial permanent disability. If you happen to lose one hand or one leg, that is called, or any two organs, uh, that is uh, permanent disability with total disability. So total will be meaning you have lost use of one of the five organs completely, and permanent or temporary can be based on time for which you have lost the use of that uh, body function. So if it is for a short period of time, it is called temporary disability. If it is for a longer period, for a very long period of time, it can be classified as permanent disability. Benefits will vary based on these classifications. Then you have accidents. You can have an accident while going on a trip in your own vehicle or a public transport or with somebody else. Coverage in all these three cases will be different. You could meet an accident at home. You could have an accident at workplace. There are different insurance policies for covering these accidents, and then there are different kind of injuries that can happen. If it's a physical injury which can be operated, which can be treated, it can be covered under hospitalization or accidental uh, covers insurance. Then there can be injury due to a medical condition which can lead to a disability, either partial or permanent or temporary. And then there are situations where you can suffer a head injury or a brain injury. So these kind of injuries are also classified for different benefits under different insurance policies. And then there is the death. So we'll talk about death benefit and death life insurance, which covers death as a risk. But illnesses, disabilities, accidents, and injuries, these are covered under different plans. So these are the situations where you are not dying, but you survive and you can recover. So these are different kind of insurance. So the financial consequences of these four risks to your life, illnesses and disabilities and accident, can be minor or major. So minor illnesses would be chronic illnesses, which might cause a small medical bill to you. You may apply some home remedies to recover. And even if you visit a hospital or a doctor to uh, get rid of the illness or injury, it's mostly outpatient. You are treated and then you are released within a few hours. So minor illnesses, minor injuries may not cause a very huge bill and may not be very affecting your ability to undergo or take care of your daily tasks or duties. So your income is generally not affected by minor illnesses. But major illnesses which require hospitalization uh, and which may also cause huge medical expenses, which may lead to an operation, which may lead to a rehabilitation expenses if you have a disability, even if it is temporary. For some time, for 1 month or 2 months, you might be needing special care while taking care of your duties and performing uh, or working or in employment. So these are rehabilitation expenses, and these costs are usually not uh, small enough to be covered out of your own pocket. So you will need some external help, or you may encash your emergency fund to meet these expenses. Now, so what out of all this, out of everything that we have discussed, what will the insurance policy cover? So what is that insurance? Where exactly you need the insurance to take care of your expenses? Also, where insurance will allow will take care of your expenses. Insurance will not take care of the minor and OPD expenses in normal circumstances. But if you're hospitalized, if you have a major operation which is covered under the policy, if you have a disability, disabilities again depends on the type of disability, and if you contract any critical illnesses. Critical illnesses are those illnesses which are life-threatening. Usually, just so for some of the examples of critical illnesses are usually cancer and heart ailments, heart attack, and renal failure. So one organ failure can be classified in critical illnesses. There are about 20 to 34 critical illnesses. Different insurance policies will cover number of illnesses. So according to the regulator, there are about 22 critical illnesses that any insurance company providing a critical illness insurance will cover any. There are pre and post hospitalization treatment expenses that insurance policy can cover if hospitalization is also covered under the policy. Then there is loss of income due to hospitalization. So if you inquire with the policy provider, they can give you a benefit of policies with benefit of cash uh, payments for the time you are hospitalized and unable to go to work or perform your employment duties. So the type of insurance policies that will cover all these expenses are usually called Mediclaim, which is the normal health insurance, and then critical illness and disability insurance. You can also look for policies with which are covering OPD treatments. So they will have a list of OPD treatments that are covered by the policy. Most of the time these treatments are one of those treatments which have been an inpatient treatment earlier, but since the technology has advanced and you can basically be free of the hospitalization, you don't have to be hospitalized and you can be treated within a couple of hours and released. So for example, a cataract treatment is nowadays a few hours, uh, 30 minutes to 45 minutes treatment, and after that you can resume your normal duties. But obviously there will be some cautionary things you will have to take care of, otherwise you are free to move around and do your normal duty and life. And then there is accidental death and disability insurance. With accidental there is a lot of misconception about accidental death and disability insurance uh, that I can elaborate you a little bit about. That is, accidental death and disability does not cover your hospitalization expenses to a great extent. So, for example, if you have a 10 lakh rupee accidental cover, so 10 lakh is payable only at the death of the insured. If you are hospitalized due to an accident, you are recovering, you have been injured and have a temporary disability. Accidental insurance may not cover it unless and until you have those conditions and those features, those benefits included in the policy. So, under normal circumstances, the standard accidental policy covers only permanent disability. That means you lose a hand, or you lose a leg, or you lose two legs or two hands, things like that. So, permanent total disability is treated as a death uh, by the policy. So, they will pay you the entire amount unless and until it is defined separately. So, and after that, policy ceases to exist. In case of partial disability, you are paid a smaller percentage of that total benefit amount, and then again the policy may cease to exist, and you will have to get a new policy. So, accidental death and disability, accidental insurance, you need to be a little bit cautious about accidental insurance. It's not a Mediclaim insurance. If you are hospitalized due to accidental injuries, accidental insurance may not take care of those expenses. You will need a health policy along with the accidental insurance. And then there is income protection clauses. So there is no separate insurance for income protection. It is a part of either your Mediclaim policy or your critical illness insurance or your accidental insurance. So it's an inbuilt feature in one of these or all of these policies. You can inquire and purchase this with the policy. Now that we have taken care of the injuries and all, about the one of the biggest questions that generally comes is how much insurance is enough in even in case of Mediclaim and critical illness policies. So see, there is no uh, limit to what kind of insurance and how much insurance you can have here. But since these are expensive policies, these are not term insurance policies with just a few thousand rupees premium for a crore rupees of sum assured. These are expensive policies. If you go for a 10 lakh medical aim, you will be paying about 20,000 per annum as premium to continue the policy at the age of 30. So it's more like what you can afford without affecting your wealth a lot. You do not need a very big policy. It's more like if you can afford a 10 lakh rupees policy, have it. And going forward, as your income increases, as your lifestyle grows, you may want to increase the sum assured to a greater extent, or if you add more family members to cover them in the same policy, you can increase the sum assured accordingly. Again, according to your affordability. Don't, because these are the insurance policies which you don't need often, but when you need, you should have sufficient adequate amount in the policy. Also, look at the features like what kind of what kind of coverage they will provide. So for example, if you have to spend 10,000 rupees on medical expenses, how what part of this 10,000 is coming from the policy and what part you have to bear out of your own pocket. So these are the things that you need to take care of in the policies which are other than death benefit policies like Mediclaim and critical illness. Other than that, everything death benefit is something that should be covered separately with a term insurance or a life insurance policy. So before we can see how much life insurance will you need, let's try to understand what kind of financial consequences death has on your life and on the lives of your dependents and immediate family members. So these are the consequences in general. What we see from the naked eye, that is, you have a loss of source of income, and that can lead to that can affect children's future, their education goals, their marriage goals, and it can destabilize families' financial status, and they may lose the financial status that they used to enjoy when you were alive. It also can lead to increased expenses in some cases, and we'll see how. And increased expenses, anyways, will lead to a financial stress on your immediate resources. So, for a family, if you consider For a family of four, it's a nuclear family considering parent and children. Uh, Family of four, where both parents are earning. So we are assuming, let's assume for ease of understanding, that father has an income of 12 lakhs and mother has an income of 7.5 lakhs, and family expenses without the father involved will be 5 lakh and 40,000 rupees. But without the mother, the expenses increase to 7 lakh and 60,000. We'll see how that happens, but these are the generic cases. These are not specific cases about a family, but most of the families will face this kind of consequence if we'll have to take care of, let's say, out of 80 out of 100 families will have a similar situation. So what happens if the primary source of income, assuming the father is the primary source of income, uh, if in case of his death, what happens is the family loses the majority income source, which is the primary income source. Long term savings will be affected because those are all coming from this income. Then and long term savings will affect the children's goal and the family's future. And immediately the family goes into saving mode, so they will have to cut down on their expenses, on their lifestyle, and maybe their financial status will also get negatively affected because of this. So uh, on the other side, if whether mother is earning or not earning, the consequences of mother's death is usually increased expenses, because mother is taking care of the children, the family's budget. They are controlling how much money is spent on food, how much money is spent on lifestyle. Without that control, you may end up spending either too much or you may end up spending too little. So depends on the situation of a family. From But in general, if it's a nuclear family, the loss of mother can lead to excessive expenses on children's care and kitchen and home. So that is why our assumption for this is, if you lose the mother, if the family loses the mother, the expenses can increase because of, you will need to hire a maid or a caretaker for children. You will need to spend more on getting the food and uh, food preparation or kitchen expenses. Now, with those things in mind, what kind of insurance are we looking at for parents? We have already covered the health insurance and critical illness, disability, accident. Uh, for covering the death benefit, we will try to include a term insurance policy according to the HLV. HLV stands for human life value. So, human life value is a very important term when it comes to insurance, and we'll see how it plays out in deciding your term insurance coverage. So, first of all, let's try to cover the primary source of income, which is the father, and how we will. So, there are multiple ways we can get to an HLV number, which will give us the amount of cover that the term insurance should have. So, when we look at, well, if you go to an insurance provider and ask what is the maximum eligibility of term cover we have, so they will give you either 10 to 20x of your annual income as term life insurance cover. So in this case, it comes around to be 2.4 crores. But again, understand that pure term insurance policy is a cost. If within the policy term, the insured, the father of the family dies, only then the family receives the money. Otherwise, the premium that the father was paying will be lost. And if, let's say, the policy will cover father at till the age of 60, and he survives till 60 and he becomes 61, all the premiums will be lost and the policy will expire without paying any benefit. So it's not always the best to have the highest amount of cover, but you should optimize it to the safest level. So we can have two ways of optimization. We'll say in first scenario, we'll say, what if we can replace the income? We will get enough money to replace the annual income of the father to the family. And if we can invest the money at 7% per annum, and we need to draw 12 lakh rupees out of this corpus, so we can get it to 1.7 crores almost. If we get 1.7 crores tomorrow, we can deposit this and we can replace the father's income to the family of 12 lakh rupees per annum. Then we can further optimize it with the need-based HLV, need-based human life value method, which is cover your expenses. So we can take care of. So we need a corpus which takes care of the family's expenses that father was contributing to. And second is it also takes care of the important goals where father's income was going to. So, for example, children's fund and marriage goals, those things can may at present, if you have 50 lakh rupees, you can easily cover. So, if we add these two, we get 1.27 crores. So, this amount will be sufficient to take care of family expenses and take care of the future goals if anything happens to the father tomorrow. So you can go with either 1.7 crores or 1.27 crores. 1.27 crores is more optimized a cost. It does not make you spend too much on premium, but it provides adequate coverage to the family. If anything happens to you, your family is safe. If nothing happens to you, you don't end up spending too much money on insurance cover. And what about the mother? So if mother is earning, like in this case, so we can go for we can have the maximum eligibility. We can check that maximum eligibility. In this case, it's coming out to be 1.5 crores, and we can or we can optimize it for with the safe rate of return, interest, which comes out to be 1.1 crores. We can further optimize it based on HLV method, which is how much expenses, and we are assuming that mother's income is not going towards any huge future goals for children or other things. So we only take care of the family expenses that mother is taking care of, and what will happen to the family expenses after mother is not there. So if you have 1.1 crores, you can take care of those expenses. So the total cover that you will need for mother's term insurance will be 1.1 crore rupees. You can further optimize it. So this is an oversimplification of it. So for calculation purposes, but this shows the factor. This gives you the clarity on the factors that will decide the term life cover in premium, uh, term life cover for the parents and for the earning members of the family or for the members who are contributing financially in one way or the other. So going forward, you can have different when nowadays you when you go to buy a term insurance policy, you can buy a pure term insurance policy, but if you research you will find there are term insurance policy which are providing uh, different kinds of fancy features and everything. So return of premium is one of the popular features. As I said, when you buy a term insurance policy, you pay the premiums for 30, 20, 30 years. And then if you survive, you don't get anything in return. So insurers will say, no problem. If you pay us 20,000 instead of 10,000 uh, per annum, we'll, if you survive the policy term, we'll return all the premiums to you. So understand that in financial world nothing is for free. So if you compare the premium of normal term insurance policy with the premium of term insurance with return of premium, you'll find that there is a gap of about 100x. So you almost double the premium that you end up paying for this policy. And at the end of the policy period, if you survive, that these all this premium is accumulated and returned it back to you without any interest. So it's a zero sum game. You don't gain anything, but you end up spending a lot in the beginning. So pure term insurance is still going to do the job, and you are not losing money on the premium that you just keep on paying, but it is less. You can simply put that premium, the gap that you have. Uh, you can put 10,000 per annum for term insurance, and you can put 10,000 in a mutual fund. And in 30 years, that 10,000 will become something much better, much bigger of value than 10,000 rupees, 20,000 rupees per annum, or 6 lakh rupees coming at the end of 30-year period. So you have a lot of multiple different choices you can take care of. So in case of insurance, it's best to not overcomplicate things and keep it simple for your family members, for your immediate dependents to have a hang of it and benefit from it. Another feature that is nowadays added to the term insurance policy is the income protection. So what term insurance providers will do is they will say, we'll give you a lump sum, we'll give your family a lump sum amount. Let's say 50 lakh will give you in lump sum to the family, which they can use to invest or pay off their debts and everything. Or and the rest of the 50 lakhs we will pay in on annual basis. So every year they will pay a fraction of that 50 lakh rupees to the family as an annual income. And this feature is called income protection feature, which is like replacing your income with the term insurance policy. There are very small benefits. A small benefit is that this payout is not taxable in the hands of your family members because this is coming as a death benefit from the insurance policy. Whereas if the policy had paid the whole 1 crore rupees in the hands of the family, and the family deposits that 50 lakh rupees in a pension plan and starts to draw uh, annual sum out of it or monthly income out of it, that monthly income can become taxable in the hands of the beneficiary. Although the entire amount, 1 crore rupees, will not be taxable, the income that they draw out of that investment will become taxable. So that is one benefit of having income protection feature and converting the sum assured to income from life insurance provider. But it's a minor benefit if spouse is not earning, uh, if not employed, and doesn't have her own tax return, then it makes no difference whether the sum assured whether the monthly income or annual income is coming from a term insurance policy or a pension plan. Then there are add-on covers like disability and critical illness that you can add to your term insurance policy, which is completely fine. You can say purchase them separately. You can purchase them with health insurance or with term insurance. So makes not much of a difference. And I suppose everybody knows the tax benefits of buying health insurance and term insurance. You get if you are following old tax regime, you can claim tax benefits under 80C and 80D. But if you're following new tax regime, you don't even need to know that. So that's why I'm not including that in this presentation. But I hope this has given you some food for thought on insurance and how to use them. Thank you very much. So also, how much insurance, as I talked about, so we have already seen that. So just to summarize, health and critical illness, check the annual premium. If you can afford it, go for it. If not, reduce the sum assured, or also check for no claim bonus. So most of the policies will give you a no claim bonus of they will increase the sum insured in the policy. So if you purchase a 5 lakh policy and next year you don't have any claims for the whole year, next year your sum insured will be more than 5 lakhs, maybe 6 lakhs or 7 lakhs. And there is a limit to which it can go to. Usually it's 100% increase. After that, it stops unless you increase the sum insured yourself with the increase in premium. In case of term insurance and personal accident insurance, which is mostly a death benefit, we follow HLV, and higher amount is not always the best option. You can optimize it to have a balance between the cost and benefit. Also, try to add disability benefits to it. It will increase your premium, but it will also be very useful as we see the cases when you are alive. uh, Often it happens that if you were not careful enough while buying the policies, you find that you don't have any cash benefit coming out of these policies until you die. So to avoid that scenario, you can add disability benefits and clarify with the insurer whether in what conditions the benefits will be paid and how much it will be paid. Thank you very much. You can post your questions on to me on these credentials, on these numbers and email. Have a good day. Bye bye.